back to our intermediate financial accounting class. In our last few segments, we've been focused on cash and receivables as part of our discussion of current assets. Remember that in our overall course, we started talking about the accounting cycle. We're now talking about the balance sheet and specifically about the current assets section of our balance sheet. And other than cash and receivables, the other major section of current assets is our inventory. So we're going to break this discussion of inventory down into two parts. We're going to start by talking about the basics, reviewing concepts with a little bit of extra thrown in there. And then we'll talk about some new topics as well as we move into our next section. Let's get started. Before we do that, though, we need to talk about why inventory is so important. Keep in mind that a company's true purpose is to sell its inventory. It's not to collect receivables in most cases, or to buy PP&E, or to take out debt. It's to sell whatever it is they've come up with. Now, this could be an idea that's a service firm, and in that case, then we don't really worry too much about an inventory account. But for most businesses, inventory is the way we make our real money. And that means we need to have a good idea on how to keep track of it, both as an internal accountant, trying to make sure we know how inventory is flowing, are we buying the right stuff, etc., and as an external stakeholder, assessing whether or not companies are doing a good job with their inventory, or are they investing in the wrong thing, and are they being able to turn it around the way we expect that they should be able to turn it around. In addition, there are lots of different options for tracking inventory. We can use FIFO, we can use LIFO, we can use periodic, we can use perpetual. There's a new method, dollar value LIFO, we'll talk about later. All of these options are available to managers. And because they're all options, they can choose any one of them. And they can choose to switch between methods. It's kind of a pain. It's considered a change in principle, and you have to go back and do quite a few calculations, but you can do it, which means that we need to be comfortable not only with what these methods are, but how to switch back and forth. In addition to that, investors need to be able to make adjustments and allowances for the different kinds of inventory. If we're looking at two different companies with similar net income, but one of them is using FIFO and one of them is using LIFO, then that second company is actually doing better because cost of goods sold under LIFO is higher. So if the net income is the same, or excuse me, if the net income of the two companies is the same and cost of goods sold is higher for company B, then company B is really doing better than company A is. And we need to be able to adjust for that, either by doing an actual calculation to make an adjustment, or just intuitively knowing, wait a minute, what inventory method are they using and how would that affect these bottom line numbers? So these are important concepts for companies, both because of their importance from a business decision making side, but also from an analysis side, and also from an audit standpoint for those going in to monitor companies and whether they're doing a good job. One of my favorite stories about auditing inventory is actually the story of a company that supposedly had cornered the market on salad dressing, specifically an Italian style dressing, and supposedly had all of this dressing on hand, vats and vats of this stuff. What they really had was one vat of dressing and a really good set of pumps. And so what they would do is they would match up one of their employees with the auditor, and the auditor would go out to check and make sure this oil was really there and the salad dressing was really there. And they'd get to the vat where all of this was stored, and they'd check it and test it, and the auditors would do their thing. And as they were moving away from that vat, they would say, okay, I think we'll head over to vat number 5, and the employee with them would say, oh, you're going to vat number 5? And they would know they needed to drain the oil from this vat and pump it over to vat 5 and fill it up, so that when the auditors got there, oh, lo and behold, yep, there's another vat of this salad dressing. So apparently this went on for quite a while before it finally got caught, and what everyone had neglected to realize was the fact that that much salad dressing would go bad before anybody could possibly eat it. It would end up rancid. So there's a lot going on with inventory. People are constantly trying to rip other people off by pretending they have the inventory or by selling them shoddy inventory. Always issues going on with people not expensing inventory like they should. So it's become a big issue in accounting, being able to track it well and audit it well and be sure that companies really have what they say they have. And if we had more time, I have lots of additional stories about auditors checking inventory, but we'll see. If we get bored halfway through, I'll throw in another story. So let's talk about the different types of companies that use inventory. Again, we're going to kind of leave service firms out of our discussion for now. They sell a service or an idea or consulting or whatever. They obviously don't use inventory or not much inventory, so we're not going to worry about them in this chapter. What we are worrying about are the two kinds of companies that do use inventory. And the first of those are manufacturing companies. Now, a manufacturing company takes raw materials and turns them into something else. It can be a big adjustment, it can be a small adjustment, but we do something with them. Because of the process of changing these assets, these raw material assets, into a finished good asset, most companies keep 3 inventory accounts. One for raw materials that they haven't started doing anything to yet, one for work in progress that we're working on but haven't finished yet, and then one finished goods for the stuff that's done and we're ready to move out of our warehouse. Now, most of these companies, when they report on their financial statements, their inventory totals, they don't break them down. They keep them in one big lump sum when they report to the SEC and just show inventory. But for internal purposes, we use all 3, and we show inventory going from one account to the next as we move it through our production process. Now, the other type of company is what we're probably most familiar with. That's a merchandising company. And a merchandising company is like Walmart or Target or Safeway, etc. They're all of these companies that buy goods from somebody else and then sell them. And so they only need one inventory account. Because we're not doing anything with our inventory, we don't need to keep track of these 3 different levels. We just put it all into inventory and call it good. The next difference in our inventory system is one that we've already talked about, and that is the difference between perpetual and periodic systems. So just as a reminder, a perpetual system tracks inventory as it comes in and goes out of the business. We keep track constantly. Uses a computer system to keep track of everything, so we're not trying to do it all by hand, but everything's there. Because everything's being kept track of constantly, we use one inventory account, and everything, discounts, returns, purchases, sales, etc. It all goes into this one account, and we keep track of everything in that one place. A periodic system, on the other hand, doesn't keep track of all of our inventory. What we keep track of are our purchases, discounts, and returns, and then at the end of the period, we calculate cost of goods sold by figuring out what goods were available to be sold, cost of goods available for sale, and subtracting out our physical count of inventory from that number. And the assumption is anything we don't still have on hand must have been sold. Whether you're using a perpetual or a periodic inventory system, the first real question is, when can we show this inventory on our books? When is it considered sold to us? And the rule here is that we can only record the inventory as ours when we have legal title to the goods. Now, in most cases, this is really straightforward. I mean, think about your own shopping trips. I go to the store, I give them money, they give me stuff, it's now mine, they keep the money, and I'm done. And for a lot of companies, especially merchandising companies, that's all there is to it. I keep track of it when I buy it. Except that there are some instances where it's not quite as clear as that. For example, what happens to goods that are in transit? Do they belong to the seller or to the buyer? We have 2 ways of separating this from an accounting perspective. It's FOB, freight on board, destination or shipping point. FOB destination means that it changes to the buyer when it reaches its destination. FOB shipping point means it transfers to the buyer as soon as it's shipped. Now, from a seller's point of view, we would much rather have this be FOB shipping point, because then it transfers to the buyer as soon as it leaves my warehouse, which means I get to book the sale immediately. I get to show that revenue. And if something goes wrong, it's their problem, not mine. So I don't have to worry about it while it's in transit. From a buyer's perspective, I'd rather have it be FOB destination. Why? Not because I care as much when it goes on my books, because it's not going to be an expense for me until I sell it to somebody else. What I'm concerned with is who is responsible for the shipping charges and damage en route, which means as a buyer, I'd much rather have it be FOB destination so that I don't have to worry about it till it actually gets to me. Anyway, FOB destination, that's one of our first issues that make it unclear when something belongs to me as a buyer. The next one are goods on consignment. Now, I'm not sure how comfortable you are with the idea of consignment sales. A consignment sale means I don't want to buy your stuff. I'll sell it for you, but I'm not going to buy it. I don't want the risk of buying it. I don't think people will buy it very quickly, or maybe you as the seller or the original producer feel that you want more of the profit than you would get if you sold it to me and then I resold it to the end customer. But for whatever reason, you and I don't enter into an agreement to sell the unit as far as you selling it to me. Instead, you hire me to sell it for you. So you ship the goods to my store. I put up a display. As people walk through, they buy my stuff that I really own, and they may buy occasionally some of your stuff, and I take a percentage, a commission, and I send the rest of the money to you. But I never own it because it belongs to you. I'm just renting you space in my store and charging you a percentage of sales. Well, from an inventory point of view, we have to be really careful with this. Goods on consignment in my store don't belong to me. So here's kind of how it works. I'm going to try to draw a picture of this. Here's my warehouse. If I have a bunch of goods on consignment and they're in my warehouse, then they're not mine. If they were mine on consignment, they would be in somebody else's store. As opposed to being in my warehouse. My goods consigned are somewhere else. If I've got goods in my warehouse that are consigned, then they must belong to somebody else. So when I'm doing inventory and I find goods on consignment, I have to know, where are they? If they're goods on consignment somewhere else, then they're probably my stuff, and I've counted them because I know the goods in that store are mine, they're on consignment there, and I need to include them in my inventory. If I go through the warehouse, my warehouse, and I find these goods that are on consignment, wait a minute, on consignment in my store or my warehouse, they're not mine, they belong to somebody else. I need to take them out of my inventory account. So that's what we're doing with consignment sales. The last thing we have to talk about are some special sales agreements, and we're going to take a little bit more time on these, but there are specific sales agreements that make it difficult to track when inventory moves from the seller to the buyer. So here's the first, sales with a buyback agreement. Now, buyback agreement means that as the seller, I make you a special deal. I say, look, why don't you buy 10,000 units? And you say, I don't want 10,000 units. I'll never be able to sell till 10,000 units. And I say, well, no problem. Tell you what, why don't you buy 10,000 units now, and in 3 months, I'll buy back anything you haven't sold. So 3 months from now, so you give me a check, you buy the stuff now, 3 months from now, I come into your store, you've still got 2,000 lying around, I take the units back with me and cut you a check for the balance. Even more savvy sellers will say, you know what, I'm not paying for it now, I'll pay for it in 3 months. And you could come and pick up the 2,000 units and I'll cut you a check for the 8,000 I really did sell. So the idea here from an inventory perspective is if they're sold on a buyback agreement, then I can't record the sale until that buyback period ends, because we're not going to pretend you've sold them and then you have to buy them back. You're just trying to get around things. This was actually a really common way for salespeople to pad their numbers for a long time, because right before Christmas, when the bonuses would come out, I would go out to all my customers and say, hey, buy a bunch of units right now for me. Don't pay for them. I'll come buy them back in January. You'll be fine. And then I would make my numbers. I'd get my bonus. And then all of a sudden we'd have a ton of inventory roll back in because I didn't really make a sale. I had this buyback. So FASB kind of put a stop to it by saying you can't count those as sales if there's a buyback agreement. The next are sales with a high rate of returns, meaning I sell them, but a lot of people bring them back. And there's lots of different reasons why this happens. The best examples I can think of are the book or movie or CD mailing clubs. You may not have even seen these. Your parents certainly remember them, where Disney would contact you and say, hey, sign up for our Disney movie club and you have to buy so many movies, but we'll give you a deal on the first few and then you'll have to buy 5 more at the regular price. Well, then every month they send you a book or a movie or a DVD or a CD or whatever it is. They send it to you. And maybe you keep it, maybe you don't. If you don't want it, you just ship it back and they don't charge you. If you keep it, then you pay for it. So as a company, I send out all these items, whatever they are, and I have no idea how many are going to roll back. So I can't count the sales unless I can come up with an estimate on how many are going to be returned. So once I've got some history, and Disney would probably be a great example. They've been doing this for years. If Disney has had 20 years of experience and we know 10% actually get kept, then I could record the sale. But if I don't know that for sure, that the numbers bounce up and down, then until the return period is over, and the checks roll in, I can't count them as sold. The last special agreement are what we call installment sales. And installment sales mean I buy it today, but I'm going to pay you over the next 6 months. Think of a rent-to-own place where you go in and you buy it, but you're going to really rent it for 6 months, and at the end of the 6 months, then they'll transfer ownership. So a rent-to-own place is a great line of business for them, not for us necessarily, but for them, because if you default, they just take the stuff back. A lot of companies, same kind of deal, they get into these installment sales, but if I sell it to you instead of leasing it to you, I can't get it back as easily. And that's where FASB's rule comes in and says, look, if you can't come up with a bad debt expense number or an allowance for bad debt for these, you can't count them as sold. You don't know how much you're going to be ripped off by people taking the good and then not paying all of the installments. And we've talked about a lot of details with inventory, and what we really need now is to pull it all together with an example. And that's where we're headed when we come back. I'll see you then.